Well, as we've mentioned, another company that gained finance from the US government is Tesla, led by the unpredictable Elon Musk. But Musk right now is stalking Twitter, of which he is a regular user. Twitter initially offered Musk a board seat on the condition he would stop buying the shares. Musk refused and offered the precise number of $54.20 a share for Twitter. I should say that 420 is the code for marijuana smoking, of which he's especially fond. His Easter tweet was of a dog dressed up, maybe a wolf in sheep's clothing perhaps, with Twitter-like Easter eggs around it. In the meantime, all tech shares have fallen in recent days, maybe a reaction to rising interest rates. So let's bring in here one of Australia's most noted technology company investors, Alex Pollak from Loftus Peak Funds. Alex, always good to have in the program.
Thanks, Ross.
I just want to go to this point. Why is it that tech companies are affected by rising interest rates, rising money market interest rates?
Oh, because the market perceives that with the tech companies, they can be a couple of years away from generating earnings. And the further out they are from generating earnings, the more funding they will require and the more interest they'll have to pay, and therefore the valuation falls.
Okay,
that's the simple one.
Yeah, okay, so that's the simple thing. But surely, given the fact that there are, numerous, perhaps even 12 interest rate rises coming in the United States, this has been well seen. Why is it suddenly now that the market's woken up to this?
Oh, well, the first of the interest rate rises, they were talking about 6 times 25. Now they're talking about a number times 50. So it's more than they actually expected. And the interest rate rises are higher as well because the inflation numbers, not that we didn't know that they were going to be chunky, but they're even chunkier than people initially thought. So everyone knew that it was heading in the direction, but people didn't know just how much it was going to go in that direction, and it surprised to the negative, made things worse.
So in other words, this is about valuing to the future, and this is all about the potential for companies, but for companies that are not making money, that may require more shareholders' funds, investors like you, to commit to them. So do you still see that there's value out there in these companies?
Well, we stick away from the ones that are more long dated. Our bet is in, if you like, the chip stocks right now. And the chip stocks, companies like TSMC, Intel is another one, AMD is another one, Nvidia is another one. Those are companies with massive earnings now, and they are the beneficiaries of a significant shift across all industries to more and more chips in cars, more chips in fridges, more chips in dog collars.
And shortage of chips, and as a result, those companies that can make them in the Western world are the beneficiaries.
That's right. So instead of playing it through the long-dated stuff with earnings somewhere down the track, we are playing it through the companies that are making earnings now. These are the companies supplying the picks and shovels, the chips now, and they're in incredibly high demand.
So very quickly, there's tech companies out this week. There's Netflix, for example, is one good example, but there are others coming out this week as well. Tesla's another. So, again, this gives you a chance to assess just how they're going and what the cash burn looks like.
Correct. But people still think that Netflix is a company that's, in some sort of difficulty. Netflix is generating $1 to $3 billion a year of free cash flow. They've done their first buyback. They're generating cash on a massive entertainment spend annually and returning money to shareholders. That's the kind of company we love to be in.
Yeah, so, and what about something like a Tesla, which, of course, now, with Elon Musk, the wealthiest in the world, he can diversify in all sorts of ways. But the reality is, it's proven. That model has now been proven.
And that's the other side of it, right? So that model has been proven, but you're paying absolutely amazingly high prices for Tesla shares. It's on a PE of 200 or 250 times. So yes, it's proven. Yes, it definitely works. Then it comes down to a valuation question about whether you're overpaying for that earning stream. So it's always a balance, right? Near-term earnings, lower price, earnings from Tesla, fantastic, but massive price you pay for them.
I'll tell you what, good to have you in the program. We'll do it again very shortly. Alex Pollak from Loftus Peak Investments.